All right, everyone, welcome back. This session is about one of the most sensitive and high risk areas of auditing, fraud. Now, fraud is not the same as error. Errors are unintentional, but fraud is deliberate, intentional, and usually well hidden. And ISA 240 is the standard that guides us as auditors on what our responsibility is when it comes to fraud. So, what does ISA 240 say? It says our job is to obtain reasonable assurance that the financial statements are free from material misstatement, whether caused by error or fraud. But here's the catch: fraud is much harder to detect. It often involves collusion, override of controls, manipulation. That's why ISA 240 links closely with ISA 200 and ISA 220 and also ISA 315 on risk assessment and ISA 330 on responses. Remember, fraud is not just a technical issue, it's a public trust issue. When fraud slips through, public confidence in auditors collapses. Now, let's be clear about responsibilities. Management and those charged with governance have the primary responsibility for preventing and detecting fraud. Our responsibility as auditors is to assess fraud risk, respond with appropriate audit procedures, and communicate when fraud is suspected or detected. We don't carry the entire burden, but we must never be careless or blind. There are two broad types of fraud relevant to auditors. Number one is fraudulent financial reporting. This is where management manipulates accounts. Number two is misappropriation of assets. This is more common in smaller entities like theft of cash, inventory, or company resources. Both are serious, but fraudulent reporting is usually more material and more dangerous because it often involves senior management. Here's the challenge: fraud is inherently harder to detect than error. Why? Three reasons. First, fraud is intentional, people cover their tracks. Second, collusion makes audit procedures ineffective. Two or more people working together can override controls. And third, management override. The very people we rely on for evidence can manipulate it. So, ISA 240 is realistic. It does not say we'll catch all frauds, but it says we must take fraud risk seriously and respond appropriately. The auditor's objectives under ISA 240 are fourfold. Number one, identify and assess the risk of material misstatement due to fraud. Number two, obtain sufficient appropriate audit evidence regarding those risks. And number three, respond appropriately to identified or suspected fraud. And number four is communication, like communicate and document our work. So the standard is very clear: fraud cannot be ignored, it must be assessed, addressed, and recorded. Let's dig deeper into the requirements. um, Professional skepticism from start to finish, always questioning, never assuming. Risk assessment procedures fraud brainstorming among the team, asking management tough questions, analyzing unusual trends, and presumed risk. Like ISA 240 says, we must always presume a risk of fraud in revenue recognition, and we must always treat management override as a fraud risk. So these two are mandatory. We can't skip them. And then the response is auditors are required to design unpredictable procedures. Why? Because management expects us to test the same things every year. If we only repeat routines, fraudsters adapt. So we might test journal entries at unusual times, review significant unusual transactions, or challenge management's accounting estimates more deeply. The idea is to surprise management and keep them uncertain about what exactly we will test. Communication is vital. If fraud is suspected, we must discuss it with management unless they are involved. Uh, we must also report to those charged with governance. And in some cases, law requires us to report externally to regulators, authorities, or the board, and of course document everything: our fraud risk assessment, the procedures we performed, the evidence we obtained, and the conclusions we reached. Let's look at a scenario. Suppose you are auditing a company and notice a big spike in sales in the last week of the year. Supporting documents are weak. Now, question is, which principle of ISA 240 applies here? And the answer is the presumption of fraud risk in revenue recognition. You would need to test cutoff, look at contracts, confirm balances, and assess whether management might be inflating sales. So, let's wrap this up. ISA 240 makes it clear fraud detection is not guaranteed, but auditors must remain skeptical, presume risk in revenue and management override, and respond with unpredictable, robust procedures. We are not fraud hunters, but we are fraud responders. If we stay alert, document well, and challenge management with professional skepticism, we reduce the risk of fraud slipping through.